Hello, my name is Keir Bowley and I'm the CIO of the Alternative Investment Solutions Group within UBP. Today joining me, I'm very honoured to have Joe Kelly, one of the managing partners at Campbell, who's going to discuss with me some of the themes or investment opportunities they see at the moment.
Thanks, Keir. I'm Joe Kelly. I'm a managing partner at Campbell. We are just over a $6 billion quant multi-strat. We've had a relationship with the UCITS platform since June of 2020. I believe we're almost at 900 million on the platform and really value and very, very grateful for the relationship with UBP.
The UBP U-Access platform really is designed to bring some of the leading alternative managers to European and UK clients via the UCITS structure. The attraction, or one of the really interesting areas of Campbell and why we partnered with Campbell, is that they apply multi-strategy approach to investing, but using quant systematic models. One of the topics that we've really been discussing today at our conference has been the impact of AI. What are you seeing within your investment approaches?
Yeah, it's obviously the topic of the day, maybe even the decade. For a systematic manager and a quant manager, you would expect, I think, two answers. One is how we incorporate it into our business, because it's really getting it to hold into finance and becoming a very, very good tool. First, in 2022 for code completion, et cetera. And now we're using it in ways that are much more sophisticated that we can discuss. And then secondly, what we see in the market from primarily our clients' perspective and how they're looking at their own exposure to AI and our role sort of within that. So first, as I mentioned, internal to Campbell. So we have a very large quant team using, tools that come into the market as they come. And now we're decades in, 50 years in the case of Campbell. And so we're used to incorporating new technologies. In this case, we started using, in 2022, we started using some of the ChatGPT tools, and they were just for efficiency within research, for instance, code completion, et cetera. But at the same time, we were very attentive to our security posture. We didn't want IP leakage. So we brought in sort of those engines within a closed cloud, our cloud. And it was interesting and evolving. And then literally this year, 2026, we brought in cloud code. Cloud code and some of the agentic tools there took it from something simple like efficiency to really having the equivalent of an engineer sitting next to you, making conclusions, scaling in ways that current engineers can't, and really taking multi-month processes and shrinking them down to days or weeks. So that was amazing. The one caveat to that we really value, though, is domain experience still matters. So the person who's in charge primarily of our AI effort is on the IC. He's a PhD in physics, and he runs our derivatives program. Without him providing context to the results inside of those AI efforts, they would not be correct, and we would not be able to trust them. And so going back and re-engineering and reshaping those answers with domain experience, we feel like is going to be a major edge within firms like ours versus, frankly, the larger firms with 20 or 30 people doing this. If they don't have domain experience, there's almost no point. From our clients' perspective, the world is awash, both private and public in AI. Even hedge fund strategies, if you look at some of the indices, look very exposed to AI. I mentioned earlier across fixed income RV, across long short equity, et cetera. You're talking about a 0.6 to a 0.8 correlation with something like a Morgan Stanley AI, a broad AI index. Our job is to continually twist investors away from some of those common factors, but at the same time make money, which in this environment you can imagine is extremely difficult without exposure to AI. But I'll give you, for instance, the UCITS multi-strat, absolute return for Campbell. Right now, year to date is about negative 0.1 to the AI factor I described earlier. And yet we're performing well this year. And so it's not as if we're intentionally twisting away, but the diversification of sort of a macro approach allows us to constrain exposures to what, maybe our clients have elsewhere and give them something unique.
Yep. And just stepping back, so at the management company level, you mentioned the adoption on AI. Is it a cost saving at the moment, or is it pretty neutral in cost because you're hiring different types of people? And what are you seeing there?
At the moment, it's neutral.
Yep.
We have, I'll use the term, burned through a lot of technology, literally loading some of the GPUs that we have and, needing to scale further, which we're in the process of doing. But at the same time, we've been able to scale the talent we currently have. And so, it is allowing us to be more efficient on really meaningful activities that will impact the portfolio over time. So right now it's about net neutral, but our two biggest expenses are people, and a very close second is this infrastructure around AI.
Yep. And then on the investment side, as you were talking about, the AI theme plays out in which of your 4 core strategies?
Yeah, it depends on if you have a thesis around AI's impact on, let's call it country policy. That's one thing that may play out like almost like a commodity protectionist type of policy that we're just in the early stages of. No one knows how that's going to play out, but to the effect that impacts a given country's financial structure, we will mine that through our macro strategies. Today, we see more of the AI theme in our equity market neutral program, which is for the UCITS strategy, about 1,500 North American names, so the biggest concentration of AI names. But even there, something as simple as equal weighting the names, each name not cap weighted the way you get in some of these overloaded US indices, allows us to not be concentrated in the tech sector. A lot of our returns this year, I think understandably, are out of utilities and some of the other areas. But the point is that we don't want to be loaded on that factor. And something as simple as equal weighting takes sort of that dynamic out of the portfolio.
And sort of the second or final theme that really investors have been very focused on this year is political risk or political events, because we seem to be, in January and February, we were very focused on deflation and disinflation. Then suddenly March, we're all into an inflationary world, and it's very macro event driven.
Yeah.
The opportunity set that throws up for you, how do you think about it, and which system should benefit?
Yeah, it's a real challenging environment for single strategies. You're either, if you're doing one of the 4 things we do, if you're just doing momentum, you can be having a great year, but some of these market disruptions, whether it's Liberation Day, the Iran war, even, SVB failing in 2023, et cetera, that would, provide some binary outcome that we're trying to avoid in terms of being beholden to a single strategy. And so for us, it is a story of diversification across, sector, strategy, speed, relative value. The one area where I think we tend to go a little quiet on returns, and we've seen this because we've been doing this a long time, is sort of zero rate dispersion globally. So to the extent that there's quantitative easing where economies, maybe are coming out of a crisis and need to inject liquidity, and there's really no dispersion from a policy perspective, we expect single-digit returns, but kind of quiet days like this or months or years like this where you're approaching 5% yield in a lot of countries, including the United States, where there's massive policy differential around the knock-on impact of the war, around the energy shock and how that's going to impact emerging markets very differently between importers and exporters of not just energy, but the knock-on around fertilizer, crops, et cetera. We invest in all of that, and we do it in both offshore, and we invest in some of the knock-on assets in UCITS without having the commodity complex in UCITS. And so right now we feel like it's an incredibly rich opportunity set. We like the dynamism because short-term tends to capture that. And we do feel like it's a good environment for our strategy.
And then final question just from myself, given that we're in the UK.
Yeah.
Exposure to UK assets, do you have any at the moment, or where do you think there is opportunities?
Yeah, we have exposure to the traditional markets, so equities, fixed income, et cetera. But it does come back to, relative to, whether it's the EU or other economies, we do invest in that. We don't have a specific opinion on the UK. I actually looked overnight with a change in control in the UK government if we had some undue exposure, and very similar to, a positive outcome in March of 2026, where a lot of discretionary traders were loaded on UK rates and got it wrong to a pretty large degree. Something as simple as just having more investments in the portfolio, what we call more bets than just 2 or 3, but maybe 200 or 300, allows us to smooth that out and hopefully build some compounding returns across those themes rather than just in one country or theme.
Thank you very much, Joe, for giving your insights today. As we said, the UAccess Campbell is one of our longest running and most successful UCITS on our platform. And I think we will have many more years together as a partnership. Thank you.
Thank you.